Welcome to new episode of Inside the Economist's Mind. All right, let's jump right in. We're looking at something that's really heating up the headlines again, trade tensions between the U.S. and the EU. We're doing a deep dive today on what feels like a pretty significant threat suddenly back on the table.
That's right. We've been reading analysis, particularly from ING Think, focusing on this potential 50% U.S. tariff on EU goods. I mean, that number alone tells you the stakes are incredibly high.
50%. Yeah, wow. It definitely caught our eye in the source material. So, look, our mission here is to really unpack what's driving this. We need to understand the threat itself, what the EU has actually offered, get past the headlines to the facts, tariffs, trade balances, figure out the potential reactions, and crucially, what this could all mean for economies, for markets. There's a deadline looming too, right? You can sort of feel the tension.
Absolutely. It's a complex picture, and the source material does help layer it out.
Okay, let's start with the spark. What kicked off this latest round of concern? It really boils down to a specific statement, doesn't it, from Donald Trump, hinting at imposing that massive 50% tariff.
And what makes it feel so urgent, as the source points out, is that mention of June 1st. It's not just talk, there's a potential date attached. That really escalates things.
Right, and it's not happening in a vacuum. It instantly brings back all those fears of a transatlantic trade war, just when maybe we thought things were calming down a bit. What's really striking in the source is that this threat is emerging despite the EU making some pretty significant offers recently.
They certainly have. The EU's been actively trying to signal, we want a deal. They delayed their own countermeasures for 90 days, pushing that deadline out to July 14th, specifically to make room for talks.
And the source suggests these weren't just, like, token gestures, right? They were trying to be substantial.
Exactly. They put forward what sounds like a pretty big offer, a $50 billion trade deal. This included things like buying more U.S. LNG, more soybeans, directly trying to address that goods trade deficit number the U.S. often cites.
Okay, so hitting that key grievance head on, what else was in the package?
Well, they also talked about zero tariffs, 0% on cars and industrial goods, tackling another old sticking point. And beyond the usual stuff, they revised proposals to cooperate on, strategic areas, energy, AI, digital infrastructure.
That sounds like trying to modernize the whole relationship, looking at the future economy.
Yeah, definitely broadening the scope. And they threw in commitments on things like international labor rights, environmental standards, economic security, too. It was a pretty broad offer.
So given all that, how did the U.S. administration take it, according to the source?
Well, the analysis suggests the U.S. administration wasn't satisfied. And what's interesting, this be a bit worrying for the talks, is the lack of clarity from the U.S. side about what they actually want for a deal. The source mentions some earlier idea about the U.S. maybe unilaterally cutting EU tariffs, but beyond that, it's kind of uncertain what the U.S. endgame is.
That uncertainty makes it hard to see the path forward. Okay, before we get deeper into the negotiation dynamics, let's ground ourselves in the facts. The source does a good job laying out the current tariff and trade balance situation. What does it actually look like?
Yeah, this is crucial because the narrative can get really simplified. The source highlights that while the average tariffs between the U.S. and EU might look similar on paper, if you dig down into specific sectors, you see really stark differences.
Okay, so where are those big differences based on the source?
Well, for example, the EU has a higher tariff on cars coming in 10% versus the U.S.'s 2.5%. And the EU tends to have higher tariffs on some food products, too. But then the U.S. has its own high barriers, like the 25% tariff on light trucks, which is way higher than the EU's 10% on those.
Right.
So depending on what you're selling, the picture looks very different. You can't just look at the average.
That's a really important point. The details matter hugely for specific industries.
Oh.
Okay, now let's talk about the trade balance figures the source mentions. This is often where the deficit talk starts.
Right. And in 2024, the EU did have a big goods surplus with the U.S., about $198.2 billion. That's the number you hear most often.
But just looking at goods is only half the story, isn't it?
Absolutely. The source is very clear. You have to look at services trade, too. And when you do that, the picture flips quite dramatically. The U.S. ran a huge services surplus with the EU in 2023, about $109 billion.
Wow, a services surplus over $100 billion. What kind of services are driving that for the U.S. side?
The source points to the big ones. IT services, think dominant American tech companies' charges for intellectual property, so software licenses, patents, that kind of thing, and financial services. The U.S. exports a lot of digital, intellectual, and financial capital.
So exporting value in ways you can't load onto a ship. Why is it so important then to look at both goods and services here?
Because focusing only on the goods deficit totally misses these massive service flows, where the U.S. is actually very strong and runs a big surplus.
Yeah.
The overall trade balance is just much more nuanced, and when you combine that with those sectoral tariff differences we talked about, well, it shows neither side is universally open or closed. It depends. The reality is just way more complex than a simple deficit story.
That context is really helpful. Okay, so with those facts on the table, is this 50% threat just a negotiation tactic? Or is it really pointing towards escalation? The source notes that Trump's threats have often come before talks like that China weekend deal, though it says that was more a delay, really.
Yeah, the analysis acknowledges that history, this kind of aggressive talk often being part of bargaining. But the source also points out that the way the U.S. administration talks about the EU seems kind of different, maybe even distinct from how they approach other partner.
Different how? What does the source say about the U.S. view of the EU specifically?
Well, it includes a pretty stark quote that has reportedly characterized the U.S. view. The EU is nastier than China. That kind of language. Well, it suggests a particularly tough stance, maybe even something more ideological, towards the EU as a negotiating partner.
Nastier than China. That's incredibly strong language. If that's really the view, it must make it hard to figure out what the U.S. administration actually wants.
Right.
The source says the U.S. endgame is tough to see.
Exactly. That lack of a clear goal from the U.S. side just adds to the uncertainty. In contrast, the EU's strategy seems, well, much clearer. The source describes it as a definite two-pronged approach. Make substantial offers, signal you're open to a deal, like we discussed.
Right.
But at the same time, very publicly prepare for escalation if the talks break down.
So, serious negotiation, but also getting the defenses ready. And if talks do collapse, the EU is apparently ready to deploy what the source calls its heaviest artillery.
They are indeed. They've got retaliatory measures lined up for July 14th if things fall apart. But, and this is key in the analysis, it's not just about slapping on tariffs in return. It's not a simple tit-for-tat on goods.
Okay, so how is the EU's heaviest artillery different then? What else are they looking at?
The source goes into some detail here. It's about moving beyond just border tariffs. They're looking at things like tighter regulations, specifically targeting U.S. tech firms in Europe, strategically delaying licenses that U.S. companies need, restricting access for U.S. firms to big public contracts within the EU,
Wow.
and even potentially limiting things like intellectual property rights and investment flows.
That sounds like a whole different kind of economic pressure. It's not just taxing goods. It's about impacting how U.S. companies actually operate inside the EU market.
Exactly. It's using a much broader toolkit. The source also mentions the potential use of something called the anti-coercion instrument, the ACI. You can think of it as like a legal framework the EU has built precisely to respond if they feel another country is using economic pressure against them. Bringing that up shows they're prepared to fight on multiple economic fronts, not just traditional trade. It suggests, maybe, a recognition that modern economic conflict is more than just tariffs.
This all sounds like it could have some really serious consequences. What does the analysis say about the economic stakes if that 50% U.S. tariff actually happened?
Yeah, the source is pretty blunt here. The impact, especially for the Eurozone, could be really significant. The estimate is that a full 50% U.S. tariff across the board could knock about 0.6 percentage points off Eurozone GDP growth.
0.6 points. That might not sound huge to everyone, but in economic terms, what can that translate to?
Well, the source says a hit like that could push the Eurozone economy very close to recession. That's a serious risk to growth.
And what about the flip side? The potential impact on the U.S. economy.
The source suggests it would likely dial up stagflationary pressures again in the U.S.
Okay, we've talked about stagflation before, but maybe just a quick reminder. How do tariffs like this feed into that?
Sure. So tariffs are basically taxes on imports, right? Slap a huge 50% tax on lots of stuff coming in, and it makes those goods more expensive for U.S. consumers and businesses. That pushes up prices inflation. At the same time, messing with trade flows like that, making parts and materials more costly, can hurt businesses, slow things down, stagnate growth. So you get that nasty mix. Rising prices, slowing growth, stagflation. A 50% tariff would be a big shock.
Got it. So, given those potential economic hits, how did the markets react when this threat resurfaced?
Well, European markets reacted pretty fast when the news broke.
Can you give us some examples from the source?
Sure. The Euro Stoxx 50 index, that big Eurozone benchmark, traded lower, down about 3%. The auto sector, which we know is sensitive because of those car tariffs, got hit harder, down maybe 4 or 5%.
And what about in, say, interest rates or currencies?
Yeah, we saw a movement there too. For instance, 2-year Euro swap rates went lower. That basically means the market started pricing in an extra 10 basis points or so of interest rate cuts from the European Central Bank this year.
So the market thinking was, okay, this trade threat could slow the economy, so the ECB might need to cut rates more.
Exactly. That's the market pricing in that economic risk. In currencies, the euro versus the dollar, EUR/USD, it dipped briefly, maybe 0.6% when the news hit. But interestingly, it bounced back fairly quickly.
Hmm.
The source speculates that bounce was probably down to market skepticism, maybe disbelief that a full 50% tariff would actually happen. We also saw the euro fall against the yen, EUR/JPY. Maybe some thought the yen, often seen as a safe haven, would benefit more than the euro if dollars were moving out. And the euro against the pound, EUR/GBP, hit its lowest since early April. The source connects that partly to the UK having recently sorted out a trade deal, maybe looking a bit more stable by comparison.
That bounce back in euro USD does seem to hint at that negotiation tactic thinking in the market, doesn't it?
It does seem that way, and the source really captures that uncertainty, basically saying, look, speculating on the outcome is really hard. Anything is possible, is the phrase they use.
That unpredictability feels like a key theme here.
It really is. And the source gives a clear warning to investors. Don't get complacent about trade risks this summer. They think June and July, leading up to that EU deadline on the 14th, could be pretty rocky for markets. Expect higher volatility in currencies as the U.S. keeps pushing the EU, and probably others, for deals.
Though short-term volatility is likely, even if the market doubts the full 50%. But does the source offer a longer-term view?
Yes, they do mention their long-held view, which is basically that in the end, if a trade war really escalated and dragged on, the economic pain for the U.S. itself would likely become too much to keep those super high tariffs going indefinitely. The idea is that economic reality would eventually force a change.
Okay, that's maybe a sliver of optimism there. So let's recap. We've gone from the shock of this 50% tariff threat, the deadline, dug into the EU's quite detailed offers, and the U.S.'s, well, less clear response. We've fact-checked the complexities of trade balances and tariffs, explored that whole negotiation versus escalation dance.
Right, including the EU's pretty sophisticated potential responses,
Right.
going way beyond just tariffs.
Exactly, that heaviest artillery.
Right.
And we've looked at the very real economic and market risks involved.
Yeah, it's clear this is far from over. It's got all the hallmarks of brinkmanship, lots of strategic moves, and just a lot of uncertainty, especially about what the U.S. administration truly wants out of this.
It definitely leaves us with a big question about where global economic relations are headed.
Yeah.
As you think about everything, we've covered these huge potential tariffs, but also the EU preparing these other tools targeting tech, IP, government contracts.
Yeah.
Here's something to chew on. Are we seeing the start of a new, maybe more complex kind of economic conflict moving beyond the old tariff wars?
Or is this all just, an incredibly high-stakes negotiation? Is it theater, ultimately aimed at getting a deal like the market's bounce back and that long-term economic view might suggest, even if the tactics are extremely aggressive?
It's a really crucial question about economic power and how it's used today. We'll definitely be watching closely to see how this unfolds. Thanks for joining us for this deep dive.